Are you a farmer struggling with financial management or perhaps considering venturing into farming and wondering how to handle the finances? You're in the right place. Today we're going to tackle the critical subject of farm finance. It's the lifeblood of any agricultural operation and can be the deciding factor between flourishing fields and fallow ground. We'll start by unpacking what farm finance is all about and why it's so crucial to your farming success. Then, we'll dive into the essentials of farm financial management, from understanding your operation's financial health to budgeting and cash flow management. We'll also explore the various financing options available to you as a farmer and discuss risk management and insurance. So whether you're a seasoned farmer or just starting out, this will be a valuable exploration for you. Stay with us as we delve into the fascinating world of farm finance. First, let's demystify what farm finance is all about. Farm finance, in its simplest form, is the management of financial resources in an agricultural business. It's about more than just money. It's about making the most of your farm's resources, ensuring the sustainability of your operations, and securing a future for your farm. So why is it so important? Well, farm finance is at the heart of every successful farming operation. It's the compass that guides your decision-making process, helping you determine where to invest your resources, how to manage your expenses, and when to expand your operations. Without a firm grasp of your farm's financial health, it's like sailing in the ocean without a map or compass. Now let's delve into the key components of farm financial management: budgeting, record-keeping, and financial planning. These elements are the building blocks of effective farm finance. Budgeting is like your farm's financial blueprint. It outlines your income and expenses, helping you allocate resources efficiently and avoid unnecessary expenditures. It's about setting financial goals and creating a plan to achieve them. Record keeping, on the other hand, is about tracking your farm's financial activities. It's like a financial diary that records your income, expenditures, assets, and liabilities. Good record keeping provides valuable insights into your farm's financial performance and aids in making informed decisions. Lastly, financial planning is about looking at the big picture. It's about setting long-term financial goals, evaluating your farm's financial health, and developing strategies to achieve these goals. It involves analyzing market trends, assessing risks, and planning for the future. In essence, understanding farm finance is about taking control of your farm's financial future. It's about making smart decisions today that will lead to a prosperous tomorrow. With a solid understanding of farm finance, you can make informed decisions that will propel your farm towards success. Now that we understand what farm finance entails, let's explore how to assess the financial health of your farm. Just like a regular health checkup is essential for our well-being, a financial checkup is vital for the prosperity of your farm. Key financial ratios and indicators come into play here, giving you a clear picture of your farm's performance. Let's delve into a few of these ratios and indicators. First up, we have the current ratio. This tells you if your farm has enough short-term assets to cover short-term liabilities. A ratio greater than 1 is generally healthy, signifying that your farm can pay its immediate bills. Next up is the debt-to-equity ratio, which measures the proportion of your farm's total assets financed by debt compared to equity. A lower ratio typically indicates a more financially stable farm. Then we have the operating profit margin ratio. This one gives you an idea of the profitability of your farm's operations. A higher ratio means your farm is generating more profit for each dollar of sales. And finally, the asset turnover ratio. This ratio measures how efficiently your farm uses its assets to generate sales. A higher ratio indicates more efficient use of assets. Now let's talk about benchmarks. Benchmarks provide a standard against which you can compare your farm's performance. For instance, if the average current ratio for farms in your region is 2, and your farm's current ratio is 1.5, it indicates that your farm's short-term financial health might be slightly below the regional average. Remember, these are just examples. The key metrics for your farm may vary based on your specific circumstances and agricultural sector. It's always a good idea to consult with a farm finance professional to understand which ratios and benchmarks are most relevant for your farm. Regularly assessing your farm's financial health is crucial to detecting potential issues early and making necessary adjustments. So, keep an eye on these indicators and ratios, and ensure your farm stays fit and thriving. Now, let's talk about budgeting and cash flow management, two vital components of farm finance. Creating a budget for your farm is like setting up a roadmap. It gives you a clear picture of where your money is going and helps you plan for the future. Start by listing all your income sources, from crop sales to livestock revenue. Then, jot down all your expenses, which could include seed costs, equipment maintenance, labor, and more. But remember, a budget is not set in stone. It's a flexible tool that should adapt as your farm grows and changes. Regularly revisiting and adjusting your budget is key to staying on top of your finances. Now let's move on to cash flow projections. This is an estimate of when and how much money will flow into and out of your farm over a certain period. It's important because it helps you understand when you'll have cash available and when you might face shortfalls. To forecast your cash flow, consider both your historical financial data and future plans. Managing expenses is another crucial aspect of cash flow management. Look for areas where you can cut costs without compromising your farm's productivity. Perhaps you can buy supplies in bulk to get a discount, or maybe you can reduce energy consumption by investing in energy-efficient equipment. Maximizing revenue is equally important. Explore new markets, consider diversifying your crops or livestock, or think about adding value-added products like jams or cheeses. Maintaining a positive cash flow is essential for your farm's survival. It ensures you have enough money to meet your immediate needs and invest in your farm's future. You can achieve this by consistently monitoring your cash flow, cutting unnecessary expenses, and finding ways to increase revenue. Remember, effective budgeting and cash flow management can make a significant difference in your farm's profitability. Of course, sometimes you need a financial boost to implement your plans. Let's look at some financing options for farmers. The first thing that comes to mind when we talk about farm financing is probably loans. From traditional bank loans to agricultural credit unions, there is a wide range of lending institutions ready to support your farming venture. Loans can be used for everything from purchasing land or equipment to funding crop production. However, it's important to remember that loans need to be paid back, often with interest, so it's crucial to have a solid plan for repayment. But loans aren't the only game in town. There are also grants available specifically for farmers. Unlike loans, grants don't need to be paid back, making them an attractive option. They can come from a variety of sources, including government agencies, nonprofit organizations, and even private companies. Keep in mind, though, that grants are typically competitive, and you'll need a strong proposal to win funding. Another source of financing is subsidies. Agricultural subsidies are government assistance paid to farmers to supplement their income, manage the supply of agricultural commodities, and influence the cost and supply of such commodities. These can be a lifeline for farmers, especially in times of market instability or downturns. Now, how do you choose the right financing option? It will depend on several factors, including your financial situation, your farm's needs, and your long-term goals. Consider the terms of the financing, the repayment schedule, and any potential strings attached. It's also a good idea to get advice from a financial advisor or someone with expertise in farm finance. Remember, financing is not a one-size-fits-all solution. What works for one farm might not work for another. So take the time to explore your options, do your research, and make an informed decision. Choosing the right financing option can significantly impact your farm's growth and sustainability. Farming comes with its share of risks. This is where risk management and insurance come in. Just like any other business, farming also requires a protective shield against unforeseen circumstances. Risks could range from unpredictable weather changes to volatile market prices, infestations, or even equipment breakdowns. The key to effectively managing these risks lies in understanding them and planning ahead. For instance, diversifying crop types can spread risks associated with weather or pests. On the other hand, forward contracts can help navigate the uncertainties of fluctuating market prices. Insurance plays a crucial role in this risk management strategy. It offers a financial safety net in case things do not go as planned. There are various types of farm insurance, including crop insurance, livestock insurance, and equipment insurance, among others. Your choice of insurance should align with your specific farm operations and the risks you face. With the right risk management strategies and insurance coverage, you can protect your farm from unexpected setbacks. So, we've covered quite a bit today on farm finance. We've delved into the nitty-gritty of farm financial management, underscoring its critical role in the success of agricultural endeavors. We've highlighted the significance of budgeting, record-keeping, and forward-thinking financial planning. We've also explored how to assess your farm's financial health, discussing key ratios and indicators that can give you a clear picture of your farm's performance. We've touched on the importance of budgeting and cash flow management, providing tips on how to maximize revenue and keep expenses in check. We've discussed various financing options available to farmers and shed light on how to choose the most suitable one. We've also emphasized the necessity of risk management and insurance in farm finance, and outlined strategies to mitigate common farming risks. In essence, prioritizing financial management can significantly enhance your farm's sustainability and profitability. Thank you for joining us today on Farming Know-How. Don't forget to subscribe for more farming tips and advice. Until next time, happy farming.